Hey guys, welcome back. Doug Smaldino here. This is part 3 of our four-part series of mortgage prequal for basics for agents. Now, we talked about credit. We talked about in the first video, it was credit in the first video. Second video, which was 2A, was about income for salaried borrowers. And then 2B was income for self-employed borrowers. So remember, we're talking about the big 3. What's the big 3? Credit, income, assets. So part 3, we're going to talk about assets. This isn't that difficult. Basically, it's common sense when you think about it. It's, how do you buy a house without the money? Yeah, you got to have money. Unless it's a VA loan. Of course, there's an exception to every rule. VA loan is if you fortunate enough to be working with a veteran, there's no down payment required. So basically, let's take a look at the slide here. Now, there's different types of loans. Fannie Mae, Freddie Mac, 5% down up to $679. We can do it. Single family. We can do it that across the U.S. Doesn't matter if it's in Los Angeles County or in Little Rock, Arkansas, because we have a special arrangement with one of our investors that we get high balance across the U.S. That's single family. So what do you need? You need 5% down, and you need money for closing costs and reserves. Now, usually gift funds, again, working with a lot of these millennial buyers, gift funds are fine. No problem with gift funds. Mom and dad, fork over some money for the down payment and closing costs. That's fair game. Money in retirement. The key is here, when you talk to your leads, say, hey, what do you have for down payment? Well, it's always going to be a little difficult question, but more and more people are, the younger millennials are tapping into mom and dad, or they might have, some of these millennials I've noticed are just buyers in general, have pretty decent amount of money in their 401k plans, and they're taking either distributions or loans against the 401k. Now, that's fair game, by the way. Either are fine for loan purposes, game pre-qual that is, but for tax purposes, you take a distribution, it's a tax hit. You get all the money, but you're going to, probably half of it's going to go to taxes. When you take a loan against the 401k account, generally, every plan's different, but generally you could take up to 50 cents on the dollar. So if you had $200,000 in a 401k, you could take a loan for $100,000 and use that towards the down payment. It's totally fine, and it's not a taxable event either. So it's a much better way to go, if possible, to do a loan versus a distribution when taking money out of 401k. FHA loans, 3.5% down up to $679 by county. Again, for down payment purposes, it's got to be seasoned money. So, look, if they want to buy a house, like I said, the title of the slide, show me the money. Where's the money coming from? How much do you have? Where'd you get it? Is it in here? If it's mattress money, that's the problem. It's not seasoned. If it's a gift funds, that's okay. If it's an inheritance, that's okay. You just have to be able to paper trail and document it. If the guy's got $50,000 under his mattress, and he goes and dumps it into the bank, that's not going to work for getting a loan. So remember, it's got to be sourced in season. A lot of questions I get are with self-employed borrowers that have, they leave a lot of money in their corporate account. They have, a couple $100,000 in their corporate account. Can they use that for the down payment? Yes, they can. Now, it's a little bit more paperwork, but it's doable. It just has to be documented. So ask the question, do they have the money? If they don't have money for the down payment and they're not a vet, what's the point? You're not going to be able to do anything for them. So don't waste your time. Jumbo is the most restrictive. They're going to want, now we do have 10% down up to $1,850,000 through Union Bank, one of our top lenders. Of course, when you get into 2 to 4 units, it gets a little bit more restrictive with the down payment. They want a little bit more down. They want more reserves. General rule is on single family, they want, a couple months worth of reserves, PITI. What's PITI? Principal, interest, taxes, insurance. In other words, if the payment for everything per month is, say, $3,000, they want to see that you have at least $6,000 to $9,000 in the bank after the close of escrow. So that's it. With that, just want to touch on the assets. So remember the big three: it's credit, it's income, it's assets. Thanks so much for coming today, guys. Really appreciate it. Stay safe out there. Reach out anytime. Any new client referrals, just send them to newclient@hillhurstmortgage.com. All right, and be good out there. Cheers.